I've renovated over 500 multifamily units in the Kansas City metro area and added more than $125,000 in monthly revenue to those units. It didn't happen overnight. Today, I'm going to break down for you guys 3 pillars of renovations or constructions that can make or break every value-add investment. I call it the 3-legged stool. It's budget, it's quality, and it's speed. Thank you guys for joining me for another episode of Own the Exit. I'm your co-host, Aaron Leatherdale. I have a lot of experience renovating properties from single-family homes to small multifamily homes to 100-unit value-add apartment complexes, all the way up to building ground-up development. And there's something, when we as investors get into properties, we always think, value-add deals, is kind of a buzzword for a while there, especially when interest rates were low. It was like, hey, let's buy a value-add deal. Let's renovate the unit. Let's, add, $200-$300 onto the rent. And, we're going to get, a multiple, of the NOI and, sell it for more. As I got into these projects, I used to have a crazy idea that a contractor would renovate a property and a property manager would manage it. And I think both of those thoughts that makes sense that they would do that, right? But as I've got into some of these deals, no, they need to be managed. So the property management team, they need to be managed. The construction team, they need to be managed because, these projects are challenging, especially on some of these like older assets like 1970s, 1960s, older vintage. We have 1940s properties even. There's a lot that goes into it. And so there's a lot of things that can go awry on the renovation side. And so that's kind of what I'm talking with you guys today is basically these 3 pillars that I've learned. And all of them have to be working in sync. The budget, the quality, and the speed. Because if you think about it, let's say that the quality is great and the speed is good, but the budget is 3 times what it should be, well, then that business plan isn't going to work because your cost is going to, the value that you create through doing those renovations doesn't even make sense, right? Or, any one of those pillars, let's say the speed is great and the budget is great and they just fly through, but the quality is bad. Well, then you have to come back and renovate it again, right? Or maybe the quality is good and the budget's good, but it takes, 6 months to renovate a housing unit, a multifamily unit, when it should have only taken, 2 weeks or 3 weeks so that a renter could go in there and you could start generating revenue. All of those scenarios I've experienced over and over again where one of those pillars is off. And so that is something that you just have to be very aware of as a multifamily investor, as somebody who's renovating properties and realizing it's hard and there are going to be a lot of challenges. And so I just want to walk you guys through these kind of 3 pillars. So the first one is going to be budget. Stuff costs a lot. And I think I see this over and over again. I see brokers sending out offering memorandums where it's like, it used to be like $3,000 a unit. And then I think they've upped, it's $6,000 or $8,000. It's like, it could be $20,000. To renovate a unit. And a lot of times too, when you get into, and we've renovated a lot of units for other people too, not even our own stuff, because we have a multifamily renovation company that we started to be able to control these 3 pillars and kind of bring them in-house. But sometimes you just don't know till you get into the walls. You start tearing stuff up. That's why I like it when on these units, whenever you can do just like a surface level renovation, like a make ready, I think it's smart. But once you start digging into walls, there's electrical stuff. There could be mold. There could be asbestos. There could be, plumbing issues, a lot of different things as you kind of dig into those unit, change orders and things like that. It's harder than new construction in that sense, because with new construction, if you have a good set of plans, you're just building it according to those plans. And there's hopefully less surprises if you have a good architect and GC, and you're just kind of following, the plan. On old stuff, you don't know what you're getting into sometimes. And so for the budget, you just got to have a big contingency on there. I've had multifamily projects where I've just gone over budget. I think we all have, if you've been involved in this business where it's just like, you even have your contingency and it's still not enough, That's kind of my joke in renovations. Like, it's going to cost more than the budget. It's going to take longer. And I know that. But even when I get into some of these projects, it still takes longer and costs more. So you have to just really be mindful of that. And so, I'm just thinking of, costs, I mean, and these are real world examples, of putting together a budget, but then all of a sudden the roofs are bad or the AC units start going out or, we've had different challenges with, exterior work, with painting, with, wood rot, as we're doing our prepping, for the exterior of these buildings. I mean, there's just so many things that can come up on old projects that it's just really important to do due diligence on really what is the cost going to be here. And I think that's very important. And so tip here, the best investors, they don't ask how cheap they can get it. They ask how smart they can spend, right? So it's not about, saving dollars, sometimes it just doesn't pay off. I mean, yes, we all want to save money, but if you're chopping, a couple other legs off of your stool there, those saved dollars are not worth it. So it's that balance, and it comes down to management. It comes down to having those right relationships with the people that can do it. And I think it's important to look at, for the budget, what every dollar that you're spending, does that dollar generate revenue? If you're doing something, if you're planting a tree out in the front, does that tree equate to, are people going to pay more for that tree? Maybe not, but maybe you're doing 3 or 4 of those things that kind of add to the appeal of the complex, where people come in and they like it. There's all these kind of subtle, where kind of like subconsciously the prospective tenants kind of are like, hey, I like this place. It's nice. The owners care for it. Yeah, that could translate into dollars, but you just have to look at it as a business decision. Every dollar that goes into it has to be something that will drive revenue or drive long-term value, or else why are you doing it? Number 2, so this is quality. Cutting corners. Man, I've had a lot of experiences with working with contractors that the quality wasn't there. And we struggle with this a lot of times when we're, as multifamily owners, if you're buying an older property, you don't have that necessarily a giant budget, because, you're trying to keep the costs really, really tight. And so it's easy to kind of get into some low quality stuff, and it's just not worth it. There's been times when I've had to pay people to do a job that I already paid someone else to do, but they did it bad. And so you had to get somebody else in there, and it's just not worth it. And you learn as you go along. But, this is something that is, the quality, there's a certain standard, right? There's class C products, there's class B, there's class A, there's different kind of tiers of quality. And, I think you just have to know, okay, what class is this asset? Is this a class A? Is this a class C? And for some of this older stuff like workforce housing or different things, hey, we're not trying to build a brand new luxury apartment complex here. We're not trying to turn it into something that it will never be, but we're trying to have, safe, clean, affordable, a nice basic rental unit. And so, there are different contractors for different projects. I have contractors for class A stuff. We're building hundreds of units right now, over 1,000 that are in the pipeline. We have different contractors on those units that are building our ground up luxury apartment complexes. They're almost like resorts. But we have a lot of older apartment complexes as well, and we have different contractors for those. We renovated our office building. We did basically a full gut of our office building where a couple of our businesses are. That was a different contractor. It was a contractor that did commercial build outs and did class A commercial renovations. That contractor doesn't do the multifamily stuff. It's just a different, you would think it's all the same. Like, hey, everybody just renovates. Well, no, there's people that specialize in different types of assets and in different qualities. And so that's what I would say about, quality, is just knowing what is it that you're wanting, and how do you, your end product, and how do you kind of balance that with the budget that you have. And then the last one, it's speed. And this is one that we forget about a lot of times, because it's like, well, hey, this is a great price. This is a nice quality, but what about the timing of the delivery of that finished, product? And this is something where you could have a contract where everything is written out, where you're going to do all this stuff, and and it's all buttoned up, line by line. Here's the finished, renovation scope. Here's the money, but there's no mention of the speed, right? And then the speed is just verbal, like, oh, I'll start next week and I'll get it done. And then what happens is it just gets dragged out, and you end up paying a lot more because the cost to you, if you're renting a unit for $1,200 or $1,500 a month for a rental unit, and let's say someone's just doing a quick renovation that should take 2 weeks, 3 weeks, maybe a month, depending on how deep they're going into, renovating it. But it takes 6 months. I mean, I'm kind of ashamed to say, but I've had single units that have taken months and months and months because we have so much stuff going. It's happened, right? If you've ever renovated units, you know what I'm talking about. It can be hard to really rein in that speed. And so that's something where it doesn't matter how great that unit is at the end of the day or how good your price was. If you take 6 months to renovate a unit, I lost thousands of dollars because that unit was just dragging on and on and on. And there's also the kind of the mental toll, right? Of and then the property manager not knowing when it's going to be ready, not knowing when they'll be able to lease it up. So there's a lot of lost kind of revenue there. We're building, like I said, multiple apartment complexes. There's one that we're building where in the contract, every day because we have basically a 23-month schedule, every single week, exactly what's happening all throughout the entire build plan. And there's some weather days that are built in there as contingencies because those are kind of we call them acts of God, where it's if nobody can show up, or if there's a, crazy rain, or if there's a lot of mud and we can't get in there, there's things like that. But it's a $3,300 per day penalty for every day that the GC is behind schedule because it costs us. It's not a punitive fee. It's just, hey, we actually have an interest carry. This is a project that's tens of millions of dollars with we have debt, we have equity, we have targets that we need to hit on our side. And so speed is very important. And if you don't hit, we set up at the beginning, hey, this is how long the project's going to take. We set up that timeline collaboratively, and then they agree to it, and they sign a contract that not only is it going to be this budget, not only is it going to be this quality, but it's going to be this speed. And if it's not, there's going to be a penalty for that. And so it's really hard to do that in lower tier value add renovations because you're working with a lower tier of contractor, if that makes sense. You're working with somebody that's, more check to check. They don't have all the infrastructure. They're not going to be a big outfit that's building the Class A stuff. So it's really hard to penalize them, and they'll just walk off the job. But it's something to keep in mind. And so, closing thoughts, you got to assess your renovation project. You got to just look and, when interest rates, were 3%, 3-4 years back now, it made sense to just buy something and just renovate it and get that upside and try to capitalize on it, try to flip it. There's people renovating, just 10% of the units, selling it on pro forma. We're in a different multifamily environment. We're in an environment where it has more stabilized, I think, where there is a critical, housing structural shortage in this country, right? There's between 4 to 5 million housing units in America that we need that aren't built yet. And it's market specific. Some markets, there's a little bit oversupply still that they're trying to absorb. And some, there's just not enough units and people can't build them fast. And then, of course, interest rates are high. So it's tough to even build. And then, with interest rates being high, it's more difficult for homeowners to buy houses. So then, of course, they rent. So that adds to the need for rental units and housing. But all that to say, it's important to just think through. It's so easy and to just have an underwriting model where it says, hey, I'm going to rent or renovate, 100 units and, it's $10,000 a unit and I'm going to do it X amount of months. And it all sounds great on paper. And in the real world, it's just way harder. And so that would be my kind of, big takeaway or point here is just really look at it and understand, hey, this is going to be harder. So I would put a contingency on the timeline that you have. If you say it's going to take 2 years, it's going to take more. If the cost is this, make sure you have a contingency because it probably is going to be more. And then for the quality as well, make sure you know who you're working with. And renovations require a lot of management, hands-on management. So if you're not managing it, hire somebody or have somebody on your team who's managing these renovations. And so yeah, like I said, I call it the three-legged stool. It's the quality, it's the speed of the renovation, and it's the budget, right? Which is how much it costs. And all three of those need to be working in conjunction, right? So that you have a successful outcome. And so that's all I got for you guys today. Thank you so much for tuning in to another episode of Own the Exit. I'm your co-host, Aaron Leatherdale. Until next time, catch you guys later.